Okay, now we're going to talk about a trade. You have the extremes, which we talk about all the time, and then you have the high volume node, and there seems to be a lot of confusion about what do I do around the high volume node? How do I trade that? What do I do? And so let's talk about that. Now, the high volume node represents the statistical mode of the auction range for you mathematicians, statisticians out there. It's not necessarily the mean or the median. It's the mode. It's where there's the most incidence occurrence within that data set. In this particular instance, a range of price activity. And that's the high volume node. And that's why you will see that's why you'll see different locations of this high volume node. You know, it's not always this nice, neat thing centered perfectly between the high and the low. It's skewed from time to time to the upside here, to the downside here, etc. And something else I want to emphasize: there's this PMB stuff. It's a concept that has been completely misunderstood, and there's an attempt to divine special information from the PMB thing that's just, it doesn't hold water. It's not valid. In other words, if this is a P, then I'm expecting this to fill in and make this a more Gaussian shape, so that the mode actually is in the second standard deviation, as opposed to one of the extremes near the third standard deviation of the blah blah blah, the range. Yeah, that's more than you wanted to know, but that's the history of the PMB thing. It was, Stottlemyre visualized this bell shape, this Gaussian shape, but the reality is you can't fit it into that nice, neat statistical equation that describes your Gaussian standard distribution of data. Okay, high volume node uses. We use the high volume node. It's an indispensable tool in what we do. It's the most, probably the most important piece of market structure, auction market visual artifact of the auction process that we can use, because it represents value, and we are using the concept of value to trade. What is we trade relative value. The extremes represent unfair value in some range, in some auction. And the high volume node in a range represents, in an auction, represents the area of most value. So the high volume node can give us objective levels of potential support and resistance. You'll hear me talk about this a lot. And it's uncanny. Go back and look at the previous DVSAs over a period of time, and you will see how often markets that are trending will break away from the high volume node to the low tick. The stock indices are famous for it, and how often that high volume node will stop a trending market on a dime. It's just uncanny. It's magic. It's our version of magic. It's the force of the high volume node. But you understand why. It's really not magic. And the high volume node can always also give us, not always, it can also give us an objective way to determine the reward or risk of a trade. All of these things we're talking about come into sort of one of the primary themes of tonight, which is trading with an edge and trading expectancy. by the way. So you need to be, if you go back and you listen to this, try to be aware that that's what most of tonight is about, is developing and identifying the edge, why, how, where, when, and what structure helps you define the variables so that you can determine whether you have an edge or not. In high volume node, the extremes are two of the necessary variables you need to know if you take a trade. Okay, if I take a trade here and my stop is here, is there a target far enough away, a logical target, that justifies the trade? James, here you go. The general guideline when the market is trading near its high volume node is to favor trades on the price side of that high volume node. Notice trading near is highlighted and bolded. It's bolded, highlighted, and underlined, sorry. And why? It is because at that place within the auction, you're at the highest level of noise, and there really is no other potential edge at that level in the absence of additional information. And that phrase, the absence of additional information, is important. Don't take a trade just because you're at a high volume node, you're bored, and it's above the high volume node, I'm going to slap on a long here. Don't do that. That's not what this is saying. Wait for the addition of other information before you do that, and usually it will show up. Okay, here you go. Here's the schematic. Here's your auction. Here's your high volume node. So the gross idea is to be long above here, short below here. If I go short in here, my stop is here. If I go long in here, my stop is here. James, you say, so why take a trade there? What additional information? And Raj answers, conviction. And I'm going to show you. I'm going to show you some stuff. But that's a good question, and we're getting there. You know, James, you should write my courses for me. You're always at it. Actually, it's quite validating because I'm going to cover that. And Raj, yes, conviction. So here's the general idea. Here's what we're looking for. We're looking for these smaller structures. Now, this is where these smaller structures in and of themselves are not tradable, but they can give me something, you know, an objective reason to enter a trade. So if I see the smaller structure begin to migrate higher, then I can go long here, and I can stop it out without having to go way down here. And why would I stop it out here? You know, the trade, you know, it's not below the high volume node. Well, it gets back to, if I enter a trade here, my expectation is that it is going to turn initiative in the time frame I'm trading, and it is going to, at a minimum, trade back up to test and hopefully take out this extreme. Well, if I enter here, then it invalidates the migration of the high volume nodes in this time frame that were the reason I took the trade. So now if it trades back to here, then it's a reset. I'm neutral. I'm back into randomness. Robert, you say, your question is, then if you enter at the extremes, why would you expect a pass-through of the HVN? Because if you're in a, and understand, we're taking, this is in a context. We don't have a position on. I'm looking for that pass-through. So if price is trading on this side of this high volume node, I have a reason to favor the long trade, and it makes sense with everything else I've said to this point. Maybe I've entered down here, okay? So maybe I'm already here, and price is up here, and it's trading above this high volume node. Well, at this point, if I'm long down here, now I can bring my stop up to here. But if I don't have a position on, in the absence of additional information and not having entered at the extreme, if I'm here and I'm trading this market, the only edge I have is to do this. But eventually, you are going to get, the market is going to trade out of this range, and then it's going to form, the process starts over again. So, Robert, you're always putting the market in the context of market condition, market structure, and then another element of both of those things is time. How long has this been going on? Is this a mature situation? But that's a good point. That's a good question. I can understand why that would be confusing. Okay, so now if I enter here and the market starts to torture me, the market always tortures you, right? Most of the time before you get your payoff or you get stopped out. We've talked about preferring the quick execution of being stopped out versus the torture. But this is just trading. So at this point, if I enter here and this thing trades up here and then starts to go down here, what do? Do I get out of my trade? I don't. If I had reason, if I entered here with a reason that the market was going higher, unless it took this out, I'm going to sit here and I'm going to make it take me out. And part of the reason I do that is that I want to be as consistent with my decision-making process and as objective as possible. And if I start getting subjective and thinking that I can read every minor swing and tick in the market, I am getting sucked into the black hole of randomness. So I would rather sit in my trade, and if it truly has not been invalidated, just because I may not be comfortable or there's some minor things going on here I really don't like, I'm going to live with that trade. I very seldom get in a trade and quote-unquote scratch the trade. Trade scratchers generally don't know what they're doing, because what they do, they get in a trade and then they get nervous. They don't have a good basis for conviction of their decision. So this is sort of my personal reality check, is to live with my trade until it's invalidated. Okay, now I would be out. I would be stopped out because I'm back into randomness. Now it's a coin flip again. And James, you said you get stopped out a lot in this stuff. Yeah, you're going to. It's just the way it is. You don't have to trade when you're near high volume node, guys. You don't have to do it. But if you're going to do it, understand the reality of it and do it the quote-unquote right way. So, my setup is invalidated because my reason for going long was what I thought I recognized as value migrating higher and maybe beginning to build momentum. So I go long, and then it peters out, and it's going to develop more. Now, at this point, you've got to be careful, and this is note to self, guys. Okay, you got to be careful, because now let's say it comes down here and it starts to twitch around and it starts working its way back up. Then you get in here and then it goes down here again, and then it does this number and it goes back up. You get in and So be careful. You don't want to get in a fight with the market around the high volume node. It will suck you in and wear you out and frustrate you to no end. So be careful. This is, and you know, Raj, James and Raj. James, you said, what do you use as a reason for entering when you're near the high volume node? And Raj said conviction, and I think that's probably the best thing. You know, if I enter here, what I'm really hoping for is to see that conviction. Let me get this thing here. You know, if I get here, I'd really like to see this wide range bar, because then if I have conviction, then I can put my stop right here, because it's either going or it doesn't. Now I'll let it do this number, but at this point, if it's coming off of the high volume node and I see conviction, first of all, I don't want to be fading this up in here. But if this is what I'm looking for. So if I enter, if I see that, you know, a little migration began and I enter here, this is what I want to see. It depends on the situation, James. 30 minutes and 5 minutes or higher. I'll give you one. And, you know, I apologize. I know when I say it depends, and it depends on the condition. You're pulling your hair out going, well, this is BS. If I could do any better than answer that, I would, but I would rather tell you it depends and be honest with you than give you a BS answer that might sound good but isn't true. Now, let me show you a trade recently. Let me find it here. Here we go. Corn. This was beautiful. All right. Okay, we had this balance area that formed. And you can go back and listen to the DVSAs and the pre-market reports, because we had been talking about this. And this is a, was a very pristine, boxy structure on the chart. It didn't have, you know, the tails that you get sometimes in some of these auctions. But, you had a market that was, you know, perfectly ripe in terms of the mature balance area. And then, if I'm not mistaken, this was pointed out. It was. I know it was. In a pre-market session, I said, okay, we're in mature balance area, and this was this is the open of the day session. So you came in, and this thing is just sitting there for you on a platter at the high volume node. This is one of these situations, James, where you could have, and how do you enter it? Again, entering a trade here, if you entered this trade short, it was a great trade. It didn't work for you, but it was a great trade because you identified a perfect situation. The only mistake here, if you saw this, was not entering a trade. But you could have entered this trade in here with a stop here. You could have entered it, you could have gone long here with a stop here. You could have gone short here with a stop here. Either way, you were at the high volume node of a mature structure, and you knew the market was going to move sharply. In a situation like this, most of the time, you're not going to get hurt at all, and you're probably not going to take any heat if you enter on a stop. So that, you can let the market make the decision for you if you don't have an opinion. And look, here's your conviction. You had conviction right when the day session opened, right here. So this is what you're looking for. And James, sometimes, you know, you don't get the ideal like this in these situations, but you'll find that you do, if you're paying attention, you get them frequently enough. And this is the other thing. This is one setup. You know, we talked about trading from the extremes. We've talked about waiting and letting the smaller degree balance area set up at the extremes of a larger degree balance area. So if you look for basically 3 trades, if you look for situations that are mature and see if where the market is trading within that structure, that's on your watch list for the next day. Then you find some markets that have established, might be in the process of establishing a range. You identify the upper extremes of those ranges, the lower extremes. That's on your watch list. So you have, at night, you're looking for 4 or 5 defined things, none of which is going to occur every day or even every other day, but one of which is probably going to occur every day and certainly every other day. So you're defining your trading. You know, you're taking that random element that eats up 99.99% of discretionary traders who aren't discretionary traders or random traders. So you have to be rules-based to develop a positive expectancy. If you're not rules-based, you'll never know if you have a positive expectancy or not, except for the fact that you'll lose money. That's how you'll know. Robert, okay, you asked a good question. If I let the market put me in, where would I put my stop? Well, if the market puts me in here, then I'm going to stop it out right here, Robert, because it goes or it doesn't. I'm not going to put it down here. If this breaks out and does this, I'm not going to let it come below this level. And regardless of what you do, Robert, you're still going to get stopped out. You can put it below that bar, like I just showed. It's going to come back and stop you out, and you say, and then it's going to take back off, and corn's going to run 35 cents in the next 4 hours. And then the next time you do it, you're going to say, well, they're not going to get me this time. I'm putting it below the high volume mode. And then the next time, it takes out that level and stops you out there. So, just understand they're out to get you, and they're going to get you eventually. There's nothing you can do to avoid it. Just be consistent. Okay, general trading tips around the high volume node. I don't know, I've lost my notes. Okay, the area around the high volume node is the area of greatest trade facilitation. The implication of that is that it tends to be more random until the market begins to transition. The more mature a balance area is, the more that high volume node will tend to reject price one way or the other in a similar form as an extreme. In other words, your moves away from the high volume node will become increasingly directional, and you've got to pay attention to those and not fade them, but they're also tails for the breakout. And it's a way to get into the initiative trade early. Now, you may think you're late if you didn't enter near the high volume node, but the reality is, if it's a mature profile, the market condition is what you're trading, and the market condition is what will bail you out, quote unquote, bail you out. I don't think there's anything necessarily impulsive or wrong, and I do that. If I'm trading a market and I can't find a setup, and I'm not in it, and I see the market begin to trade with conviction, if it's a a 3 or 4 day profile, mature balance area, and I'm looking on I'm watching I've got it on a 30-minute chart, and I have a 5-minute chart up. If I see that wide range 5-minute bar, I'm going in. I'm taking the trade because I'm trading market condition. So the area around the high volume node contains the most price randomness as long as the market is in balance. The high volume node acts as an attractor as long as the perception of value that created that range holds. Price is regressive around value. What kills traders is that they misuse that concept. And the concept is, yes, price is regressive around value, always has been, always will be. But value changes. So this speaks back to market condition, market development. Do I have reason to believe this is a mature profile? And that this market that I'm looking at is close to a transition into vertical development. And this is one of these concepts. I really wish I could give you a definition of markets that were on the cusp of breaking in the transition into vertical development, but I can't. The good news is that if I could, it would no longer be tradable because they'd program it and the edge would go away. So the beauty of this is that it is a market reality, but it's slippery enough that it's not binary enough to be able to program. Okay, the benefit of trading near the high volume node is that you can catch the beginning of some pretty substantial trends, obviously. The downside, James, you and I are going to get stopped out a lot doing that. My slides are doing some funky things tonight. I'm sure I did it. You know, I'm not blaming it on the slide. This is Tom operator era. You always want to, we talk about the same things over and over. You want to identify the migration of value in at least one degree of time frame greater than the one you're trading and only take trades in that direction. I emphasize it's a sound idea. This will bail you out of trouble. It will give you definition. If you are new, if you are struggling with this, I don't care how long you've been trading it. If you're struggling with this, one of the neat things about this is you can default back to some basic principles and start building on the foundations again without, maybe you've gotten sloppy. Maybe you're trying to be too nuanced with it. Well, take some of the nuance out and get more structure and more definition. Go back to that and build again. And this is one of the things you can do if you're struggling. Identify the migration of value in at least one degree of time frame greater than the one you're trading, and then only take the setups that we discussed tonight in that direction, in the direction of the migration of value. And if you can't identify the migration of value, like say in the stock indices right now, wait until you can. Actually, the migration of value in stock indices on an intermediate term basis is up. Short term, who knows? We might find out tomorrow. You never want to find yourself on the wrong side of a high volume node for long. This is to address, I came up with this, I've been saying this forever. This was to address the people that want to fade everything and then want to average down in the position. And that you can connect the dots here and see why the incorrigible faders that fade everything always blow up, because it works. They average in, they get out at break even. Tomorrow they come in, they fade some range, they make a little bit of money. The next day they come in, they fade a range, they get underwater, they keep adding all day long, the market comes back, they get out at break even, and then you have a day like today in the stock indices. And by 9:45, it's overbought on all their oscillators, and they start shorting it. And, they were short into the close, and now they've lost, every nickel in their account. And if you think I'm making that up and being facetious, I'm not. I promise you, a bunch of people blew up today. And you can always, on any wide range day, it's the demise of a significant number of retail S&P day traders, because they fade everything. You don't fade value. We talked about this. The auction process is uniquely, consistently fractal, but be careful and don't understand you can go down in time frame to the point of randomness with anything, and you can with this. So don't do that. Be smart with this. Just because you can identify an auction process on a 1-minute chart doesn't mean it's tradable. And going up in time frame, this is another one of the base foundations. If you find yourself struggling, go up in time frame. Don't look at 5-minute charts. Don't look at anything less than a 30-minute chart. And this is directly contrary to what you hear out there. I see stuff advertised. We trade the S&P with a 3-tick stop. And, the implication is we don't use much risk. And actually, if you go up in time frame, most of the time you're decreasing your risk because you're taking out randomness out of your trading. And anything you can do to take randomness out of your decision process, and you can take randomness out of your trading, decreases your risk. You want to take trades that have a realistic potential of 3 to 1. You want to look for larger degree opportunities, balance areas on multi-day balance areas. Understand, only trade what you presently understand. You don't have to force anything. I promise you. I hope you are getting more and more excited about the opportunities that you see for yourself to develop and trade consistently and profitably. But I don't want you to do things too fast. I've said this before. So what if it takes you 3 months, 6 months, 9 months, a year in the big picture to prove and to work on this, so that at the end of it, you have developed your trade plan that you can trade based on what you understand and what you consistently recognize and what you have proven through keeping records. You can trade and have a reasonable expectation of making money, or at least not destroying yourself. So what if it takes you a year? If you come out of this, at the end of 12 months, if you come out of this and you say, you know what, I've got an edge here. In 12 months, you have a new profession. And then in another 12 months, you've really started to accumulate some capital. And in another 12 months, now you're into your 3rd year, then you can really start to plan and begin to increase your size. So how many things do you think, how many professions are there where you can start from day one and in 3 years expect to be well on your way to having an incredible financial opportunity, and hopefully, a lifestyle that you really enjoy. So it's not about being able to do everything that we've talked about doing tomorrow or at the end of this course. Be realistic with yourself. The more realistic you are, the higher the probability you're going to be able to achieve your goals. And I'm not saying it's going to take 3 years. It might take, if you've been trading for a number of years and you inherently understand some of this stuff and some of the things that you've been doing fit with it, then it won't take, it might not take you as long. But my point is that in the big picture, it's not unrealistic to take a year, 2, 3 years, and so what, for the opportunity that this presents. Now, we talked about this a little bit earlier. Each month, and this is just one little exercise you can do to get you to focus on the process, and that's the bigger point of this. Focus on the process, refine the process. Each month, see if you can exceed the previous month's largest winning trade overall and in an individual contract. And if you just do this one little thing, this will improve your trading. It will make you, and it will, force is a bad word because force conjures up this vision of I've got to sit here and grit my teeth and, tape my mouse to the desk so I won't do the wrong thing. You will naturally begin to do the things you need to be doing if you will focus on the process and evolving. It's unrealistic for someone that has been scalping for 3 years in the S&P, who has never had bigger than a 4-point winner, to all of a sudden catch a 20-handle winning trade. It's just probably not going to happen. But it is realistic if you begin to understand the concept. And the next time you take a 4-handle winner, you look at it and you go, all right, now, that thing went 10 handles. And if I had, instead of taking off the thing when it hit 4 handles, if I, even if I just tighten my stop to 3 handles, it still dropped another 6 handles. And before it would have, et cetera, I can lower it. So you can play games with yourself, focusing on the right thing that will help you to evolve naturally without, this anxiety and, doing things that are not immediately natural to you. And over time, it will become part of your process just naturally.